My name is Andrew Stotts, and I want to welcome you to this final presentation of the Valuation Master Class student of ours. Her name is DP, we call her, and she's been busting her butt to get to this point to do a final presentation. 12 weeks, and many, many hours to build some competitive advantage in company valuation. And today we're going to get a chance to see it. The company is McDonald's, and I haven't looked at McDonald's for a while, so I am really looking forward to this. So, DP, how are you doing? You ready to go? You hear me?
Yeah.
Okay. All right. So I'm going to bring up your presentation, and now it's up on the screen. So I think we're pretty much ready to go now. And so I'm going to exit, and then you just kick it off, okay?
All right.
Okay, I'm exiting now. Go.
Okay. So, good day, everyone. I'm going to present my valuation report, and my name is Divya Priya Gaur, and I initiate coverage on McDonald's with a buy recommendation with FCFF based target price of 324 US dollars, indicating an upside of 4.4% with a WACC of 7.7% and a terminal growth rate of 2%. I'll talk more about it later. The highlights of my valuation include menu innovation is set to drive 3 billion US dollars in revenue growth. AI driven personalization is to boost digital sales to past 50% of the total revenue. And the third one, amid a global franchise CAGR of 7.2%, the global risks are contained to 1 billion US dollar. And I'll share one major investor risk in the last. Now let's move to its background. So, McDonald's is world's largest fast food chain operating in 100 plus countries in over 40,000 locations, and it holds 7.7% market share in global quick service restaurants industry. Its moat lies in its brand loyalty, global reach, and a scalable franchise model. Moving to stories, the first story mentions that in 2023 alone, its strategic menu innovation drove 10% increase in sales, and value-driven pricing increased the average order values beyond $10 per ticket. So, given similar ongoing initiatives, I expect menu innovation and pricing strategy to add 3 billion to its revenue by 2029. As per second story, AI powered menu recommendations have been increasing the check sizes regularly. And the digital sales already account for 40% of the total sales. So I expect them to exceed 50% of the total sales and add 5 billion US dollars to the revenue by 2029 with a CAGR of 3.5%. The third story mentions despite 7.2% global franchise CAGR, the international setbacks do pose some risks like boycotts, inflation, E. coli outbreak in Colorado, but the company is taking solid steps to counter this decline. So, yes, the company is in a strong spot for growth because the growth drivers are strong. But what might hinder them? So let's consider the constraints to its growth next. Here are four constraints. Capital is a minor constraint because the model limits and a negative cash conversion cycle and that it collects more spending. Second, safety, but its diverse supply operation constraint, not a market constraint, because this its loyalty and innovation. The fourth, that's a company training attain the talent. So there is no major barrier to McDonald's growth at present. But how efficient is that growth? services and 38% from company operated restaurants. Geographically, its revenue is diversified with 49% coming from lead international markets, 41% coming from US, 10% from foundational markets. So the franchise led enables fast and efficient growth. But that alone doesn't make it. What about its fundamentals, its stock price? Is it fair? To find out, let's examine its FVMR scorecard on the following slide. So, this is an investment framework developed by A-Start's Investment Research, and it ranks the companies on fundamentals, valuation, momentum, and risk. So, overall, McDonald's holds a neutral rank among 1,680 non financial companies. And the fundamentals show strong profit margins, but negative equity due to buybacks. So, that leads to a low rank. In valuation, it's neutral because it's in line with the peers on its PE. In momentum, it's moderately unattractive due to weak price and earnings trend. And in risk, its debt ratio is negative, that's due to buybacks again, but a low beta signals low risk. So overall, it has a neutral FVMR, which may sound average, but ironically, it's good for investors because it's mainly due to share buybacks, and that reflects strong capital returns. Now, I'll talk about its industry. So let's move to Porter's five forces for that. So in this framework, McDonald's scores 67%, which indicate a moderately attractive industry. And the rivalry among competitors score is 80% because competition is fierce. But McDonald's tech advancement and scale stand out. Now, next factor. Supplier power score is 73% because it relies entirely on external suppliers. But its diverse sourcing helps ensure negotiation leverage. On the right, the customer power score is 60% because there are many alternatives with low switching costs. Moving to next, new entrant score is 53% because it's easy to start a small fast food business, but it's hard to scale to McDonald's level. And the final substitute score is 67% because no current player matches McDonald's in scale and technology. So, industry wise, also, it's a reliable bet. Now, next up is leadership. So, McDonald's has above average board independence and institutional ownership, which shows investor confidence. And the chairman and CEO, Chris Kempczynski, has led for nearly a decade, driving consistent growth. So, it has reliable leadership as well. Now, let's compare McDonald's to its peers. So, here, according to world class benchmarking, it is in the top 10% globally among 840 large consumer discretionary companies since 2022 for profitable growth. And the profitability is excellent with rank number one, but growth metrics have dipped. And the asset efficiency is low, but strong cost control offsets this and drives the overall rank number one in profitable growth. So there is room for improvement in growth, but the overall rank one ensures that it's indeed a better investment than 90% of its peers. Now, I will skip the next three slides because they just repeat these ranks separately. And then I will show you how this company performs in responsibility issues, the ESG. So let's skip. And here, the overall ESG score for this company, but it should be higher. And I'll tell you why in a bit. First, the environmental score is 60% because it faced some past deforestation allegations. Also has eco-friendly policies. Next, the social pillar has a perfect score because it's of its full global compliance. But the governance score is low due to CEO and chairman are the same one person. But this is offset by its strong board independence and reliable leadership. So while technically low in governance, practically McDonald's would score higher in both governance and in overall ESG. Now, do the financials back it up too? So let's move to financial reports. Here, in quarter 4 2024, the revenue fell, but that was due to one time reasons because the gross margin rose by 0.6% year on year, thanks to better menu mix and lower input costs. So, the recent past performance looks good. Now, let's move to forecasts. So, here I forecast EBIT and net profit to grow, which is in line with the stories that I shared earlier. Next is assets, having steady growth to support the expansion plans. Now, you might recall its equity is negative. That's on the next slide. Here, I forecast it to turn positive by 2028 because earnings will likely outpace the repurchases by then. Moving to cash flow. It's positive and it's steady, confirming the strong fundamentals. Now I will move to its valuation. But since McDonald's has a negative equity, so its ROE is irrelevant. So let's move to next. Here, on a PEG basis in 2025, it's trading at a premium as compared to Asia and US. That's backed by its strong earnings potential. Now, I'll talk about my assumptions in the next slide. So I use a risk-free rate of 1.7%, 7.7% WACC, and 2% terminal growth rate with FCFF due to its capital structure neutrality. And that gives us a target price of $324. Now, in the sensitivity analysis on the following page, you can see that even a 2% dip in gross margin, the current price would still be the lower than the target price. So the downside is limited. Now, let's see one major risk that I hinted at in the beginning. It is the consumer's shift towards healthier food because it hits at their core menu and it to affordability and the market share. So that concludes my coverage, and this report should not be viewed as an offer for subscription or sale of the security. It's for information purpose only. So to sum it up, with menu innovation, AI, and franchise as strong drivers and manageable risk, I strongly recommend a buy on McDonald's with a target price of 324 US dollars. Thank you. Now I'm open for questions.
Okay. It's a very low upside. What,
Yeah.
you know, why is it so low if you've got, positive view on things?
Yeah, because it is facing some saturation in some of the markets. Like in the developed countries, it's already almost everywhere. But the emerging markets do have a large scope, but to keep it conservative, I haven't used a large upside, which is possible given the emerging markets. But still, to keep it conservative, I have kept it at this level.
And if I look at your recurring EPS growth on this table here, for 2006 and 2007, it's about 5 or 6%. If I look at that, 5 or 6%, I would say that's not a huge number. I'm just curious why you are positive about it when, let's say, EPS growth is about 5%.
Yeah, because it faced some temporary setbacks in 2024 and 2023 due to there was an E. coli outbreak in Colorado and there were some boycotts in Mid East. So that has led to its low EPS growth because its revenue also declined because of that. But then, since they were just one-time factors, it is likely to improve in the future.
And let's look at your free cash flow table so I can just understand what you're forecasting.
Yeah.
Okay.
Yep.
Yep. Let me just look at this. So basically, your forecast is that free cash flow, you could say in 2024, the last historic period, it was flat. Then it's going to be flat, up a little bit, then flat, flat, flat. So basically, it's got relatively slow growth, free cash flow.
Yeah.
Uh, I'm just, again, let's I'm trying to understand why you're getting a low upside, but and you're still thinking it's a buy. Let's look at your valuation page.
Yeah.
Okay, so let me just look at this for a second. So you've got a 10% cost of equity, which I would say is reasonable. I mean, you could even, yeah, it's low risk, I think. So
Yeah. Yeah.
0.75 for beta, 10% cost of equity is not unreasonable. Cost of debt is tiny. Uh, in fact, you could argue that that could go up over the next few years, but for right now, let's say 2.4. 30% debt as a percent of capital is reasonable. Uh, yeah, so I'm curious, again, looking at it, what would it take for you to put a sell on it? Let's ask it that way. What would have to happen for you to change from you got 4% upside in a buy? What would have to happen for you to say this is a sell now?
Okay. So maybe it faces another disruption in supply chain, like the E. coli outbreak that was totally unexpected. One of the supplier was responsible for it, and it
Hmm.
was contaminated onion supply that caused a lot of stir in Colorado. People were so much against it that they stopped going to the stores, and its sales declined. So if any such incident, which is possible, but we can't expect it to not happen. So any such incident that can literally take its revenue down and cause a sell rating for the company.
Okay. Um, hold on one second. Hold on. So how does it feel to graduate from the Valuation Master Class Bootcamp and professional?
It feels surreal because I did not expect to even complete the boot camp first. My exams were going on at that time, so it was like overwhelming. I can't do it, I thought, but because of your support, your team, and also my family, I completed that, and then eventually it just happened, and in fact it felt easier to me than the boot
Mm.
camp. That's probably because I got used to the method, because of your strategic teaching style, the course overall. So it feels surreal if I just go back 3 months, but now it feels like I am able to value companies,
Was
which was
Yeah.
something.
And was it?
Yeah.
Would you say it was worth it? I mean, I'm sure it's a lot of time over 3 months. It occupied your mind and your time. Would you say it was worth it?
Yes. Yeah, it was definitely worth it. I can confidently say that I can value companies. I, Definitely, I can. And this framework has taught me way more about finance than any other YouTube video or
Had you
anything.
tried any other ways of learning before this, or were you just doing traditional ways like school or something like that? Or tell us a little bit about what you had been doing before.
Yeah, so I took up MBA in finance to learn more about finance, and then also took courses on like online learning courses and some workshops for just 1 day or two. So they would just like sprinkle the salt about what valuation is actually about. But this is what taught me what really valuation is, to understand the terms. Now I just don't know the terms, I know the meaning behind them, what it actually
Hmm.
means. And it has made me a finance professional,
Yeah.
I guess.
And it's funny because a lot of people always ask me, like, should I do an MBA or should I do CFA? And I always tell them, like, don't do MBA for finance because that's kind of a general degree. And a master's in finance I would argue, can be really technical sometimes, depending on the school, where the teachers just are focused on lots of quantitative stuff that may not add a lot of value. So I'm just curious, like, what your thoughts are about your MBA experience and, your journey as you're trying to figure out how to figure this out.
Well, MBA is just for, that I would be honest about it. It's just for the
Mm,
companies to see that you have a degree, like a professional degree in that. But for real valuation experience, hands on learning, this masterclass is
mm,
a must, because MBAs are not going to teach us this. They're just going to be theoretical, and even if practical, then not this much
yeah,
practical. This is really what will make us valuable for the companies in
yeah.
real.
Um, it's well, you've actually really impressed us because you've been one of the few, maybe if only the only person that stayed on track in professional relentlessly. And that was, an impressive performance. So you should be really proud of what you've accomplished, but also the way you accomplished it.
So thank you so much, and it's because of you all. You know it already, and also my family, of course. But uh, the framework, it's so
Mm,
structured. It's easy to follow, and I guess because my exams got over from the university, I got a lot of extra time to do
yeah.
this. So that's really helpful
All right.
too.
Well, congratulations. We're going to exit this for now and then just hang on and I'll see you in just a second. But well done.
Um,
All right.
Thank you so much.
Hold on. Well, that was impressive. DP's definitely built some competitive advantage in company valuation, and it was great to watch her performance. She's really shined throughout the Valuation Masterclass. If you want to build a competitive advantage in company valuation, then join us. The next boot camp, in fact, I'll just put this up. The next boot camp starts May 26th, right there. Just go to valuationmasterclass.com/bootcamp to learn more. My name is Andrew Stotson. I'll see you in the